Management Studies, Government City College, Autonomous Napal, Hyderabad. I welcome you, sir. I welcome you, ma'am, for this teleconference. They both are having a rich experience in higher education and both are experts in finance. For the first 45 minutes, we are going to have in-depth discussion with our resource person, whereas the last 15 minutes, we will be having a interaction session as a question and answer session, where if you have any queries, if you have any doubt, or if you want to ask any question with our resource person related to today's topic, you can call us on the number that is 040-2368-0456. I repeat, 040-2368-0456. With the help of this number, you can contact us. Plus, please make sure that whatever the questions you are going to ask must be related to today's topic. So let us begin with today. First, I want to give you a brief information about today's topic, that is financial institutions and market, that connects people who have money with those who borrows money. Financial institutions are the organizations like banks, credit unions and investment or companies that deals with monies, whereas financial market is a place where buyers and sellers exchange financial instruments like shares, bonds and currencies. So now I want to ask question to Dr. Nazia Sultana, ma'am. Ma'am, what are financial market and what is the structure of this market?
Thank you, Iffat ma'am. Dear learners, welcome to this session on financial institutions and markets. Basically, it is an introductory session where you would be learning about what are financial institutions and why are they essential to the economy. Now, when you talk about money, we all know that money is the central focus of growth of an economy, and that particular money you can multiply not by keeping money by itself, because money does not multiply when it is idle, but money multiplies only when it is put to use. So how do you make use of that particular money? There are sources wherein money have to go very productively so that it is not wasted, as it is one of the resource that is being earned through hard work, or it is being earned through a lot of use of intellectual capabilities of people or technical know-how that the people have got, or even through the companies which are engaging in productive activities. Now all this money which is there in the market, or it is with the individuals, or with the financial institutions, or with the corporations, all this money has to be channelized or it has to be put to use. So when we talk about, for example, if we get up in the morning and we talk about having a breakfast where we need milk or bread, we go to a retail store or a physical market where we buy all these things. Now in case we are getting an income, say for example an income of 50,000 or 60,000 per month, where our expenses are only 40, what are you doing with the remaining 20,000 that you have got? So this money has to be actually given to somebody who can make use of it in a productive manner. So that channel where this money actually goes and how the facilitation takes place, where people who have got surplus with them towards those who have got deficit want to make use of this particular money. So financial markets are basically places or comprises of those institutions wherein the surplus from those who have excess of money is being channelized to those who can put that particular money to productive use. Now for example, you talk about an individual, for instance me, if I am having an excess of 1,000 rupees with me and I know that there is a carpenter who is constructing a house, and that particular carpenter needs a tool which is costing rupees 1,000 for him, for example. Now instead of keeping that 1,000 rupees which I have surplus with me, that wouldn't earn me anything. Rather, I would give that 1,000 to the carpenter who would actually buy the tool to make use of that tool in the entire construction process. So what happens there is, I am not keeping the 1,000 rupees idle with me. I am giving it to the person who wants to make use of it by buying a tool. Now this person, when he buys the carpentry tool, he will make use of the tool in order to earn an income, and because I have lent him the money, he would return to me the excess that he has earned, maybe in the form of interest to me. So that way my 1,000 would now become maybe 1,100 if he has earned 200 in excess. So out of that 200 which the carpenter might have earned, 100 rupees he will keep for himself, 100 probably he would give to me. So my 1,000 has now become 1,100 and his income was 0, which has now become 100 for him. So that way what happens is, people those who have excess money, they are able to channelize this money to those who are in need of the money, so that that can be put to a productive use. So that way financial institutions are places where all this happens. Now for example, we have all of us who are earning, and we all have income with us. Now after spending, when we have a surplus, that particular surplus, I wouldn't go to a CEO of a company and say, look, do you want a loan? Right, that is it is beyond my reach. So that particular CEO can actually in turn go to a market where money is being raised, either through issue of shares or through bonds or debentures, or he may go to a financial institution like a bank or any other institution, like if it is a company is engaged into agriculture, or if it is engaged into any industry, then those related financial institutions, they may go and demand a loan from them. So what happens here is, I am not going to the CEO of a firm and lending the money directly. I am giving the money to a financial market where money is being raised, or I am giving the money to an institution which is an intermediary, and that intermediary in turn lends the money to the business. So what happens there is, this entire channelization of the money takes place in a financial market as such.
Thank you, ma'am, for this clear and thoughtful explanation. I am sure our listeners are having a clear idea what is the meaning of financial market and its structure. Now let's move forward. I would like to ask a question to Dr. K. Mallikarjuna Rao sir. Sir, why do you think that the financial markets are important for any economy, especially a developing country like India?
Ma'am, thank you, viewers. Ma'am, any economy without financial market providing a lifeblood to the industries. So without financial market, industry cannot be grow, cannot be provide employment opportunities. We can't see the sustainable growth and employment opportunities. So like India, we need a strong financial market where it creates sustainable development growth and providing employment opportunities, creating more and more opportunity for production capacity, manufacturing increase. Like, let us see the first capital formation. So the financial market provides corporations or government, they can procure finance through capital markets, like they can issue bonds, debentures and other financial assets. After issuing the financial assets, the company can procure the money, they utilize for proper purposes, and they can spend money for either expanding infrastructure facilities or expanding the business operations, like they need money. Let's understand, now we know the BSE and NSE. So BSE more than 5,000 stocks are listed, and NSE 2,000 stocks are listed. They mobilized almost 1.5 trillion economy they provided. So like even foreign investors also investing on market, they are help for capital formation. So second thing is these financial markets provide resource allocation also. Like India, we required proper financial resources for various sectors, like emerging sectors, solar energy and renewable energies, like infrastructure technology, infrastructure sectors. Other sectors required more resources. These financial markets provide resources to the industries. At the same time, these financial market provide job opportunities for our employees. Then the production capacity increases, manufacturing cycle increases, then naturally employees get the more jobs and more income. The government also getting these more income through these financial markets. Apart from this, the financial market helps for price discovery and increase the standard of living. So the fair market, getting the fair price value, at the same time it's depending upon demand and supply. Then either policymaker or investor, they can know the exact price value, and it helps, financial market helps this what kind of return they are expecting the market, what kind of risk is there, like the financial market give the direction. At the same time, the financial market helps for creating jobs, at the same time increasing this standard of living for the people. At the same time, the financial market also helps for risk management, economic expansion. Under risk management, financial markets started financial derivatives. Under financial derivatives, options, futures and index futures, and also see that these financial derivatives are helps for hedging purpose. At the same time, insurance sector and green bonds all are helps to the financial sector to get more and more economic expansion. At the same time, the one more thing is economic indicator. The financial markets showing as a economic indicator, like is a barometer. So the growth of stock markets indicates how India will grow. Like BSC and NSC, like we have a barometers or what we call BSC Sensex. It consists of 50 stocks. It consists of 30 stocks Sensex. Nifty is 50 stocks. Now we have another next 50 like bank index. Like there are so many indices are there. So these indices growth also indicates how our economy will grow. At the same time, recent period RBI also last 3 consecutive period RBI also cutting the interest rate. It helps to boost our economy for increasing our employment opportunity, all this. At the same time, the government also getting more revenue if the market grow up. Like let's understand these GST collections. So GST collections every month more than 1.5 lakhs crore rupees on a year 24-25. We'll see the GST collections are more than 22 lakhs crore rupees. So if the government get good taxes, government can spend more money to this infrastructure development, at the same time welfare schemes. So like a strong financial markets are required any nation to create wealth, to create a strong economy. Like a vision is Viksit Bharat by 2047. India is required a strong financial market. It helps for we reach the target, and 2047 India become a developed nations.
Yes, that is absolutely true. A healthy financial market leads to a growing economy. The progress of any economy is totally linked with its financial market. Thank you so much, sir, for summing up it so effectively. Next, coming back to Nazia ma'am, I would like to know, could you please elaborate how funds flow through the financial system?
Sure. What happens is, in financial system we have borrowers and we have lenders, and to connect these borrowers and lenders we need some mechanism. That mechanism can either be a market, or the mechanism can either be some intermediaries who are functioning in the market. So when we have people who save money with them, or whom we also called as lenders, it need not be individuals, it can also be companies which have surplus money, it can also be government which also will sometimes lend. So you have households, you have salaried employees, you have other individuals who are running self-employment or businesses, you can have corporations, you can have government. All these who save money, who have excess money with them, they will all be called as savers and lenders. Now all those people who require money, it could be again a person, say for example a salaried employee might have surplus. A salaried employee then becomes a lender if he has a surplus. If the salaried employee is thinking about buying a house, then he will be a borrower when he takes a home loan. So here what happens is, a financial market becomes a place for connecting borrowers and lenders. These connections can either be through the market itself, where you are raising money, or it can be through an intermediary who is helping to raise the money. So how the money flows is in the form of 2 ways. They can be direct finance or they can be indirect finance. When you talk about direct finance, the borrower, the lenders and the savers, what they do is they lend money through the market directly to the borrower. For example, the borrower is a company who wants to raise money through issue of shares, or the borrower is a company who wants to borrow money through issue of a debenture, which we call as a debt or a loan. Or the borrower is a company who wants to raise money by giving a bond. Now bonds, shares and debentures, these are all called as financial instruments. All these instruments are being traded in the financial markets. So when these borrowers are wanting to raise money through issue of shares or bond or a debenture, what they do is they will go to the financial market and they will issue these financial instruments. So all the savers and the lenders, they will buy this financial instrument in the market. So this is called direct finance, where borrowers and lenders are connected. On the other hand, I don't want to trade in all these securities. All my surplus which I have, I want to give it to a bank, or I want to give it to a financial intermediary. So this particular intermediary, for example a mutual fund company or an investment bank, I have a surplus money with me, I have given this money to a mutual fund company. This particular company in turn will pool all the money from the savers, and they will in turn lend the money to the borrowers. So this mechanism is called as mechanism through financial intermediaries. So the savers or the lenders are giving money to the borrowers directly, which is called direct finance, where they trade in securities, shares, bonds or debentures, or they give money to the institutions which are called intermediaries like banks or non-banking finance company, and these companies will in turn lend to the corporations or any other borrower who may want the money. So that way you have a direct mechanism of issue of flow of funds, or you have got the indirect mechanism for flow of funds in the financial market. So that way it's a place which connects borrowers and lenders, where flow of funds can either happen directly or flow of funds can happen indirectly in the market.
Thank you, ma'am, for your explanation. I hope our learners will have an idea like how money moves from the savers to the borrowers. In continuation to your answer, ma'am, I would like to ask you what exactly comprises of these financial markets?
Right. Now, when we say that, money is raised in the financial market, we have lot of components in the financial markets. The first basic component in the market can be a debt market or an equity market. What are we doing here is we are classifying the financial market based on the instrument which is traded in the market. When you say a debt market, we are talking about borrowing and lending which is happening through an instrument which has a fixed bearing criteria with it. For example, a company raises money from a market by issue of debentures. So this debenture is an instrument which is like a loan which the company takes from the savers. So all those people who have surplus money in the economy, they will buy debentures of a company, or they give a loan to the company in the form of a debt. So you call it as debt financing or issue of debentures by the company. So debentures are basically fixed income bearing security for the saver, where the saver who lends the money is getting in turn interest on the debenture which is being issued by the company. So it is like, there is a company A who wants to borrow money, and I am a person who has saved money. So they will issue the debenture and I will subscribe to that particular debenture. Now the debenture can have a term period of 5 or 10 years, which means my money is going to be locked up in the company for 5 or 10 years. During that particular period, until maturity, the company is going to pay me interest. So my money, which is the principal amount, remains with the company till maturity, and until maturity, I am earning interest, which is my income. So that is called as debt financing or issue of debenture. Or the company can do issue of equity shares, where company is actually issuing a part of their share capital, whereby people who are savers, they actually become shareholders of the company by subscribing to the shares of the company. So stock is being divided and that stock is being distributed among those who want to buy the shares of a company. And here one thing that we need to remember is shares are freely traded in the stock market, which is a secondary market, in which I'll just come a little later to it. So when shares are being traded in the market, as an investor, what am I looking at is that my money should multiply, and how the money multiplies is when the company gets a profit. So this is first part where we talk about debt or equity market. Second part is when we are talking about primary and secondary market. For example, if there is a company which is issuing shares, debt or bond for the first time, so then they make use of the primary market, which is also called as the new issue market. Then we have a secondary market where already issued shares are being traded. So therefore resold or buying and selling takes place. That is called as a secondary market. So you have that as another component where we say primary and secondary market. Then we have a market, in the financial market we have a composition which is called as a money market and a capital market. This is based on the maturity of the instrument. If the instrument has a maturity which is less than 1 year, they are all traded in the money market. In case the instrument has a maturity which is beyond 1 year, then they are all traded in the capital market. Then we also have a market which is called as over the counter. Over the counter exchange is one where as an individual I don't know the nuances of the stock market and new issue market and all that, but I have money with me. So what I will do is that excess money I will give it to brokers, agents or investment bankers, and these people will trade among themselves, or brokers, agents and these investment bankers will make an announcement for those of them who have money to buy from them. So they will have an inventory of securities or stocks and they will trade in that inventory of security or stock, which is called over the counter. In India we have got over the counter exchange, And in India, we have the primary market and we have secondary market in the form of all stock exchanges, BSE, NSE, or stock exchange for the commodities market, which is called multi-commodity exchange in India, and many other markets which are there. So that way, depending on nature of instrument, term of maturity, or what is the mechanism of issue, based on that, all this will become the components of the financial markets which are there.
Thank you, ma'am, for explaining about the various components, including the money market, capital market, foreign exchange market and derivative markets. As you are explaining with the help of example, I am sure it's clear to all our listeners. Coming back to sir, I want to ask you, like, could you please take us through the journey of Indian capital market, particularly after 1990s?
Yes. So Indian capital market origin trace back 18th century, where Bombay Stock Exchange and Kolkata Stock Exchange. But formally stocks are traded in BSE, Bombay Stock Exchange, starts with the late 19th century. But before 1990, until 1990, so the market relatively inactive, highly regulated, and most of the corporates are procuring the funds, either development institutions or commercial banks for day-to-day expenses or long-term loans. So the market is very limited, and there are rules and regulations are there, and say that we called as a license charge. So our growth rate is just 2.5%. Then Government of India has taken a bigger step to financial reforms in the year 1991. Then we liberalized our policies. Then we invited private people to participate our economy. At the same time, we invited global players also enter the economy. And then in the year 1992, SEBI was established. The object of SEBI is to protect investors' interest, fair transactions, and foundation for modern capital markets. So like SEBI is playing a vital role, it starts with 1992. Then you can see that 93-94, we see that we have a new stock market, National Stock Exchange, NSE is called. So it is the first stock exchange started. It's a fully automated screen-based trading system started 1994, and they started NSE National 50, what is called National 50, started composed of 50 stocks. It's one of the major benchmarks now. Along with the same time, BSE also started online screening. It helps the investor to know fair and transparent of stock market price movements. At the same time, you can see that 1996 and 2000 period, Depository Act 1996. So based on Depository Act, NSDL and CDSL, National Depositories Securities Limited, and say that all the stocks are dematerialized. Now it's called a demat, right? There is no, the paperwork is limited, transparency in the transactions, easy settlement. So like demat, the process started in 1996 and 2000 period. And 2001-2005, we can see that the markets allowed for derivative system, both NSE and BSE. At the same time, previously our market is T plus 3 days, trading day plus 3 day policy. Then 2000 period, T plus 3 days to 3 plus 2 days. Now we have a T plus 1 day. So at the time is a T plus 2 day, say that the settlement process very easily. It increase the liquidity position to these investors, and they can move one stock to another stock, easy settlement process, the processing cost also less. That happened in the year 2006 and 2007 period. But surprisingly, in the year 2006 and 2010, we have witnessed for global financial crisis because of the Lehman Brothers. The majority sectors like IT sector affected, real estate sector affected, banking sector affected. At the time our market was collapsed 21,000 points to 9,000 points in October 2008. But rapid growth, we see that in 2008, because of IPOs and stringent SEBI policies, help economy to grow and push back to same growth rate. In the year we see that in 2008 crisis, but 2011, 2015, so it is time for financial inclusion. The new government 2014 started Pradhan Mantri Jan Dhan Yojana, so linking with giving this open zero bank account for rural women and rural people. So many people are not linked with banks. Then more than, now we can see the data, 55 crores people are opened the account through the Pradhan Mantri Jan Dhan Yojana. So they are included in financial inclusion the period, and also see that technology advancements. At the same time, in the year 2006, the government has taken a step on demonetization November. At the same time, in next year 2017, we see that the GST has launched in the year 2017, July 1st onwards. Then these two are temporarily our market disrupted, but again the market will be pick up boosting based on the capital market reforms, and NSE and NSE crossed with 12,000 points in the year 2019. And also see that SEBI has framed stringent regulations for credit rating agencies, and they can a lot of steps for inside traders to enhance market integrity. At the same time, you can see that the period for the last 5 years, 2001 to 2005, so it is IPOs, initial public offer boom, and digitalization and global market integrated. So like after, see ma'am, in the year 1991, our BSE is only 1900 points. Now we can see that we are 82,000 points. Right. At the time our currency, now where we are. At the time what reserves are there, now our present reserves are there. So like our economy is moving for Viksit Bharat, now it is called as a Amrut Kal. So like these markets are day by day giving more priority, our economy is closely integrated, even Indian companies are procuring the funds, not only India, other markets also they have procured the funds, even FI flows are increased. Like there are more, we can see the different kind of economic conditions 1991 to present.
Thank you, sir, for taking us through the major milestones of Indian capital market. In continuation to your answer, could you also please share with us some of the recent developments in financial markets, especially from the last 5 years, sir?
Yes, ma'am. So after 1991, we stepped a lot of initiation for the government and policymakers. But last 5 years, see our GDP growth rate. So except 2000 to 2001, it is a negative growth rate. After that, our growth rates are 8.7, 7.0, 8.2. The last year, our growth rate is 7.4%. So our economy is capital formation, at the same time innovations, regulation framework are a help for growing our economy. But last 5 years, the major changes in the market is digital transformation. So like we know, everyone knows using this Phone Pay, Google Pay, Bharat Pay, Rose Pay, like we have so many infotech, what we call fintech sector is growing a lot, and see that more than 2,100 startups they are getting the funds from these financial markets. At the same time, we have these growth rates, digital lending also, like what we call buy now and pay later. Like we have a Just Money and Zero Money, Zero Tap, Cashy. That's also startups also very successful for market. And also see that we have wealth tech, wealth technology, Grow, Zerodha, and Akko insurance sector, Policy Bazaar. We have a lot of changes happening last 5 years. And the second thing is, the very interesting thing is the growth rate of mutual funds. So mutual fund growth rate, we see this earlier, first mutual fund is 1964, that is called US 64. But last 5 years, the industry has providing more savings to this economy. Like earlier we have only limited schemes, but last 5 years we have seen a lot of schemes happening. More than 75 lakhs crores assets under management under 40 plus companies, 40 plus companies. So they offer more than 500 mutual fund schemes, but various purposes. So like mutual fund industry providing more contribution. And surprisingly, one more thing is SIP, systematic investment plan, also they are playing a very important role. The rural people and also semi-urban people also participated in mutual fund, and that is the reason it is one of these emerging sector in finance sector is called as a mutual fund sector. Third one is regulatory reforms. So SEBI has taken a lot of steps for regulating the market, and day by day like they can reducing the whatever the issues are there, cyber securities are there, some are insider tradings, and whatever issues are there, always SEBI is proactive to change this and focus on how best we can protect investors' interest. At the same time, the policymakers, the government liberalizing our policies allowed FDI for various sectors like agriculture sector 100%, and see that mining, textile industry, pharmaceutical industry. Surprising insurance sector, last budget announced for 100% automatic route allowed in FDIs in insurance sector. It also gives penetration of insurance sector and also cost of premium may be lesser, and the policyholder get the more benefits. And the fourth one is stock market and IPOs. So most IPOs will see these unicorns, they procure the funds through IPOs. The stock market also perform well last 5 years, and see that the major IPOs are Zomato and Policybazaar and 197 Communication. These also they mobilize funds in the through stock market. And the last 5 years the banking sector also perform well, and NAVs, non-performing assets, also declined last year. It's come to 2.62, it's only 0.6%. It is a good sign. And rural banks also providing the loans for priority sectors. At the same time, financial inclusion, as earlier I told you, it is Jan Dhan Yojana and rural penetration increases. They are connected bank, it is also helps the economy grow. And see that consumer credit, banking sector also perform well, insurance sector perform well, and some of the emerging sectors like emerging sectors focus on travel, tourism, luxury sector, healthcare sector, and see that life insurance sector, and especially the green energy like hydrogen, renewable energies, service sector, industry sector. These sector are emerging. Next couple of years we will see the rapid growth on this sector also. So like we have seen a lot of changes happening last 5 years in financial market. It helps providing better jobs, growth of economy, and GDP growth, that all we have witnessed in last 5 years, ma'am.
Thank you, sir, for highlighting the key changes. I hope all our learners are understanding and noting down the relevance of financial markets and its institution for the growth of any economy. Coming back to Nazia ma'am, I would like to ask you, could you inform us how sometimes financial institutions are also responsible for financial crisis?
Very good question, ma'am, because most of the time when we think about financial markets, we are talking positively all the time, and we are saying that financial markets are necessary for channelizing funds, productive use of money, borrowers are able to raise money. All these are all positive aspects which are there, but at times we also have to remember that these markets are not an exception to mistakes or scams or anything else that may go untowards. They are also prone to all kinds of crises which may happen. For example, when sir was just dealing and he gave a hinted towards the 2007 financial crisis. The entire world has witnessed 2006-2007 financial crisis. Thanks to the strong RBI policies that we had at that time, that Indian economy did not crumple, though we had a little effect on the stock markets, but the economy was still strong. The then finance minister and the then RBI governor, Professor Rangarajan and Dr. Manmohan Singh, they all had strong financial economic policies which had a strong shield towards our economy. But financial crises nevertheless occur, and they all hurt the entire functioning of the financial system. Take the same example of 2006-07 financial crisis, where we had, which we call as subprime lending crisis. So during that crisis, what happened was, in USA you had all these mortgage firms which were lending money, and all the borrowers took the money from these firms and took houses on mortgage, and they had to now repay the money. So when the economy, you have the circular economy where you have flow of funds, and when at any point of time the flow of funds stops, you have the ripple effect which is seen on all the other connecting segments which are there. So during that time we had these two investment bankers, I remember the names Bernstein and Lehman Brothers. These two were the companies which were actually lending money for individuals to buy houses on mortgage loans. So when the individuals were unable to repay, it had the effect on the investment bankers, who in turn took reinsurance from the insurance firms and also banks. So the bank failure of insurance companies, investment bankers and individuals, all these had effect on the economy. And after the World War II, if I am correct, the whole of the world suffered the Great Recession. If the recession was during World War II, 2006 and 7 was one of the greatest times where the economy of the whole world was crumbling. We had New York Stock Exchange which failed. ripple effect on Japan Stock Exchange, which is Tokyo. That was a major stock exchange dealing at that point of time, and then Indian stock market also had suffered there. But thanks to the regulatory system that we have here, that strong policies related to monetary and credit policy of RBI, insurance companies where you have the regulator IRDAI, they also have strong insurance regulation policies which are there, and the major regulator in terms of stock market, which is SEBI, the Securities and Exchange Board of India. All these regulators had played a very crucial role in protecting Indian economy from suffering all these financial crises which are there. And then, as Sir rightly was pointing out, the developments which have happened in the entire financial system, we have seen how India has opened up towards new economic reforms from 1991 onwards, and there is lot of flow of foreign funds into the economy in the form of foreign direct investment and foreign institutional investment. So all those investors who have money abroad, they want to invest in Indian companies. They can choose the route of FDI, other companies also. On the other hand, I don't want to invest directly in a company here in India, but maybe I want to choose an institution and give it to an institution there. For example, if there's a who is there in Europe or USA and they have excess money and they want to channelize that money in Indian economy, they can directly buy the shares of an Indian company and do FDI. As Sir was hinting, 100% FDI is allowed in insurance sector. Retail, earlier also in many retail companies we have seen foreign investment which has been flowing, and foreign brands which have also flown in India, and we have so many foreign retail stores which are being set up here. So all this is the route of getting foreign money through FDI. So on the other hand, when foreign investors don't want to invest directly, they give the money to a institution. For example, a foreign investor is interested in investing in Indian agricultural economy, because today we are talking about agri-tech companies which have come up, where technology and agriculture are blending, and then we are talking about sustainable agriculture, agri-tech companies which are growing. So if a foreign investor would want to invest in an agri-tech company, they may rather, instead of investing in the company, they may give it to NABARD, which is National Agricultural Bank for Rural and Agricultural Development. So this particular bank will in turn lend the money to the agri-tech company. So this route, if a foreign investor is choosing, it is called foreign institutional investment. So why are we talking about this in terms of financial crisis, where Iffat ma'am has asked the question? We are talking about flow of money from a foreign territory to an Indian territory. We have a mechanism of foreign exchange functioning there. So the foreign exchange mechanism is also disrupted many times by a lot of international factors. Maybe today we are talking about geopolitical crisis which we are facing in terms of war between the countries, heavy tariffs which are levied, WTO rules and regulation, loans given by international monetary funds. All these are all related to foreign investment which is being concerned. So any kind of untoward incident which may happen in all these segments also will have effect on the financial system. But as I already said, Indian economy and Indian financial system are strong enough because of lot of regulatory bodies which are governing each one of the segments, like RBI for banks, IRDAI for insurance, SEBI for stocks. So that way we have the regulators who are playing their crucial roles and protecting Indian economy towards the financial crisis. But however, all the economies of the world have to prepare themselves with strong regulatory and monetary and credit policy to safeguard against any further future financial crisis which may occur as such.
Thank you, ma'am. Now we can understand that even a small mistake done by our financial markets can have a huge impact on our total economy. Moving ahead, I would like to ask Sir, can you please elaborate us what is primary market and how do companies raise money through this market?
Okay, ma'am. So the primary market is called as a new issue market, where funds are, where the companies can sell their bonds and debentures at the first time to the new shareholders and new investors. So directly they can, there is no third party, they can directly sell the market in a primary market. The funds can be raised for various purposes, like expanding their existing business, or they can enter mergers or acquisition purpose, or they can develop infrastructure facilities. At the same time, they can have a repayment of debt. So recent period, most of the company, they are mobilized the funds through IPO for repayment repayment purpose. So, like company have their own strategies, their own objectives to come forward to issue the primary IPOs through primary market. Whereas the secondary market is existing market where already shares are issued in a primary market are listed in stock market, is providing for liquidity and other purposes. So, understand the process of primary market. So, first the primary market IPOs starts with first preparation of draft red herring prospects. So, this prospect is prepared by ma'am.
Hello.
Hello, madam. My name is Saira, madam.
Yes.
I'm calling from Khammam, madam. I would
Yes.
like to ask a question.
Please.
Madam, what changes have been introduced in money supply measures as per the recommendation of the working group on money supply 1998 changed by Dr. Y.V. Reddy? Also, I would like to ask a question like what are the monetary policy transmission effects, madam, on like RBI reverse repo and reverse repo rates?
Ma'am.
So, I like to ask you, ma'am, I like to ask you.
Yeah,
about this.
when sir has questioned about monetary policy, repo rate and all, usually what happens is when we talk about regulations in a market, banks are there which are regulated by RBI. And how is the regulation happening? We have RBI is the central bank in the country, and RBI regulates all the banking activities which are done by commercial banks, cooperative banks, private banks, foreign banks which are operating in India. So, we have all these banks which are all controlled by the RBI. Now, how is the control being exercised? The control is being exercised through monetary policy. Now, when you talk about monetary policy of the economy, we are talking about RBI and Ministry of Finance. Together, they frame the monetary and the credit policy. Under monetary policy, we have the components which are related to rates which are determined by the RBI. Now, when bank is lending to the customers, we have a separate rate tradings which happens, and when bank is lending to corporations or when banks are borrowing from each other. So, that way we have got interbank transactions which happen. We have transactions which are happening between a bank and an individual like customer like you and me, or bank and the corporations, companies which are there. So, here we need to remember the concept of something called as cash reserve ratio, and we have concept called as SLR, which is statutory liquidity ratio. We have a concept called repo rate and a reverse repo rate. All these four rates will help regulation of the entire banking transaction which happen. Now, if you talk about, why is it that there is more and more supply of money in the form of loans which is happening nowadays? Now, you see almost everybody, I'm sure sir, me or others also, maybe the caller himself must have taken loan from a bank where earlier it was not so easy to take a loan. Today we see, so many of our students are also going overseas and studying abroad because banks are able to provide all these educational loans. So, we have plethora of loans in the form of education, home loans, loans to borrow jewelry, gold loans, loans which are for consumer durables, like you want to buy a refrigerator, a very big Sony Bravia television set, something, so you have consumer durable loans which are given. So, all these loans are all being guided through lot of interest rates. So, all these interest rates again roll back to your monetary policy of the bank, where we talk about the cash reserve ratio. Now, what happens is in a day when you have got these money which comes into the bank in the form of deposits, out of those deposits banks will lend. So, bank cannot lend everything that they got as a deposit, because on a fine day, what if all the depositors come and withdraw their money? So, what bank will do is, out of all the deposits that they have got, they will set aside certain money which is called as a reserve, and out that reserve they will not touch. Whatever remains from after saving from that reserve, that they will lend to the lenders. So, that CRR ratio is nothing but cash reserve. So, whatever are the deposits set aside and then lending happens. Similarly, you have something called as statutory liquidity ratio, because banks also does not have to, over the period of functioning, a bank has to be safeguarded from all kinds of closure or scams or bankruptcy and liquidity, insolvency. So, to do that, banks are being asked to compulsorily maintain their liquidity position, so that the cash flow is sufficiently maintained in the bank. On the other hand, when banks are borrowing from one another, For example, bank A is there which has excess and bank B wants a short term loan from bank A, which we also call as call money. So during that particular period, the rate which is determined for interbank transaction, all these put together is a part of the monetary policy which is there. So that way it helps, the entire framework which is being given by the RBI, the central bank, and all other countries of the world also. They have a central bank which actually regulates the entire mechanism through all these rates which are there. I hope I have answered the question given by the caller there.
Thank you, ma'am. I'm sure you have given a clear idea to our caller. Next, moving forward, I would like to ask sir.
Ma'am, I continue that.
Yeah.
Sure, sir.
Yes, the process of the primary market is first the company asking for this what we call the company asking for investment banker or underwriter to assess the company and evaluate the company based on that, decide the size of the shares and price range of the shares and evaluate the values. Based on that, the prepared draft red herring prospects. So second stage, once it's prepared, the same red herring prospects are submitted to SEBI for further approval. So SEBI, what they can go for the company balance sheets, all this, checking the transparency and how these money is procured, what purposes, what they are doing, what are these vision and mission, all they go through it. Then it's approved. Once SEBI is approved, then the IPO come to the market. Once this IPO is come to the market through the book building process, this investors as well as investors and either domestic investor, foreign investors or corporate people, other corporates also, they can come and participate. They can bid price rate within the range, whatever the range offered. So based on that, once that whatever the time is given, the time period is over, then the shares is allotted on the priority base. Like the priority given these institutional investors, at the same time priority also given for retail investors based on the how many shares they are allotted, either pro rata base, that shares can be allotted. When the shares are allotted, after certain period, the shares can be listed in this stock market. So starting with draft red herring prospect to listing of this share, all the process comes under primary market. So under different types of primary market offers are there, like IPOs and right issues, private placements, priority what we call professional allotment. So different types are there. Companies deciding which method is suitable for them for getting this or procuring the funds for their reaching the object. In the last 5 years, and we were waiting for this financial SEBI approval, like HDB Financial Services waiting for SEBI approval, and Oyo Hotels also waiting for approval. Volo Electric Mobility is also waiting for approval. Other Housing Finance Limited is also waiting for approval. So all major players are waiting for use approval. Once SEBI is approved, they can issue their IPOs. So last couple of years we have seen that the major IPOs in our financial market, like LIC. So LICs procure more than 20,000 crores. It is one of the largest IPO ever in India by massive market pressure and government banking. At the same time, the payment, like what we call, everyone knows Paytm. So nothing but it is a 197 communication. They also issued an 2001 IPOs like Coal India, Reliance Power, and Zomato is also issued IPOs through in the financial market. They are procured the fund, the primary market. Last 5 years of primary market is very active. It's IPOs are more and more. In future also, most of unicorns, they are ready to come forward to issue IPO. They are ready to procure the funds through financial this primary market, and it is one of the better source of finance to the firm can issue these securities.
Thank you, sir, for breaking it down so clearly. Now I request Nazia ma'am to give his concluding remarks on this topic.
Yeah. What happens, Iffat ma'am, is because we have been dealing with financial institutions and an introductory session to the financial institution, I'm sure the learners by now have got an idea of what is a financial market, what are the various financial institutions, why are they actually needed for an economy. So here, when I would say concluding remarks, I would urge all the learners to also become earners, so that they start earning, and out of that earning to spend a little and save a little, and with whatever they save multiply the money through that saving. And how do you do that? The financial markets are the rescue for you. So where you go to a bank, make investments, you have lot of risky assets as well as risk-free assets. So in case somebody is a person who wants to take risk, depending on their aptitude, depending on their behavior related to investment, then you can actually choose risky assets like stocks, which are also some of the innovative financial instruments are also available, where we talk about commodity derivatives and all. So you can invest in case you have a risk aptitude, you can make investment there, because high risk also yields high return. In case you are a risk averse investor where you don't want to take a risk, then you can invest in safe securities such as fixed deposits of a bank, or in India we have got postal savings where we have national savings certificate issued by the post office, or we also have lot of other schemes related to the government where investments can take place, like pension funds, which are also a safe avenue. So like that, depending on whatever risk aptitude you have got, how much savings you have, make use of those savings to start investing so that the money multiplies. Start investing in also ventures where you are able to get a regular income in the form of there's a SIP or mutual funds, and make investment. And the whole system is actually in place, because after independence, Indian economy built itself very strongly, the foundations of the financial system. So when the system is already there, it is for us to make use of the system, whether we are borrowers or whether we are lenders. So therefore I urge all the learners, as I said, become earners very quickly, start finding employment option, start earning, spend out of that, because spending also is an income to somebody else, and whatever you save after spending, start investing that saving so that you multiply your money. With those concluding remarks, I think we have summed up with the financial markets which we have started the discussion on.
Thank you, ma'am, for your concluding remarks. I request sir to give his concluding remarks.
Dear students, I would like to encourage you to understand the financial market, how it works, what are the various financial assets are available, and you can understand each financial asset, what is the risk proportion, what is the return is there. So recently, last couple of years, we see that most of the young generation people are open demat account, are invested in derivatives like options market. Quick money is not possible to getting in the stock market. Surprising, more than 1 lakh crores of amount lose by these young investors. Right, they are educated, be taken something, they are unable to understand how the market it flows. So if you are investing any stock, and if you are selecting, go to the fundamentals, go for fundamental analysis, see the company stock, what kind of business model it is, how it will work, spend some time, they understand, then only you can invest, and you can suggest your parents and your neighbors to this is the best stock, and see the best investment avenue based on your prospects. Either you can choose your career as a financial analyst or financial planner, or you are a career as a finance, or you can better investor, save the money, and don't believe whatever this YouTube channel they are promoting the stocks and these don't depending upon, go to the company website, see the company balance sheets, understand the financials, and see that you use AI also. AI can analyze the data and give these key inputs. Right now, AI generators, what we call generative AIs, they can analyze 5,000 balance sheets within a span of very quick. They can give these important points. Either you can know what is the company debt equity ratio, what is the PE ratio, what is the sales, like the basic parameters to understand the company, then you can invest. Right. So invest is most important to in an equity market, either debt market. So I request the students better to invest, start early, and plan accordingly. Then you can help for your own purpose. At the same time, economies also helps, and don't depend again I request, don't depend upon whatever the YouTube channel showing is not the correct. You can go the company website, analyze the data, and spend some time, and using generative AIs, and invest properly, save your money, and get a good return. So this is my concluding remarks, ma'am.
Thank you, sir, for your concluding remarks. So dear students, I am sure you have had a wonderful insight into the subject to financial institutions and markets through the enriching discussion we had today. I sincerely thanks our panel member, that is a resource person, Dr. Mallikarjuna Rao sir, Dr. Nazia ma'am, for sharing their knowledge and guiding our students through this informative session. I also extend my thanks to Department of Commerce at BRAOU for organizing this talk, and the production team, editing team at studio for making this live session possible. Thank you one and all. Please keep learning, keep exploring. Thank you.